Fidelity ran a study to find their best performing investors. The winners were not the active traders, the strategy switchers, or the finance guys. They were people who had completely forgotten they had an account, or were dead. Let that sink in for a second. The people beating everyone else on Wall Street were not doing anything. They were not watching CNBC. They were not rebalancing every quarter. They just stopped. And somehow, that made them rich. Here is what most investing videos will not tell you. Your strategy is probably not the problem. The S&P 500 has averaged around 10% per year for decades. Index funds are widely available. The information is out there. So why do most people fail at investing? Because they cannot stick to it. The average investor earns around 3.7% per year. The average fund they invest in returns closer to 10%. That is a 6% annual gap. And it has nothing to do with picking bad stocks. It is entirely explained by one thing. People keep switching strategies at the worst possible moment. This has a name. Financial planner Carl Richards calls it the behavior gap. And a research firm called Dalbar has tracked investor behavior every year since 1994 and found the same pattern every single time. Markets go up, investor returns lag behind. Every year, without fail. The clearest example? 2008. Markets crashed.
It was the worst day on Wall Street since the crash of 1987.
Markets crashed. People panicked, pulled their money out, moved everything to cash. Vanguard tracked what happened next. The investors who did absolutely nothing recovered twice as fast as the ones who adjusted their strategy. Doing nothing beat doing something. Every time. Harry Markowitz won the Nobel Prize in economics. He literally invented modern portfolio theory. The mathematical framework that tells you exactly how to allocate your investments to maximize returns and minimize risk. This man spent his career telling other people the optimal way to invest. And when someone asked him how he personally invested his own money, he said he split it 50-50 between stocks and bonds. Not because it was optimal, he knew it was not, but because he could not stand the thought of watching stocks crash and knowing he could have had more in bonds. The regret would have been unbearable. If the guy who invented the math cannot follow his own math, what chance do the rest of us have? The problem is not your strategy, it is your brain. We are wired to feel losses twice as intensely as gains. Watching your portfolio drop 20% does not feel like losing $200 out of every $1,000. It feels like the entire thing is collapsing. So we do the worst possible thing. We sell, we switch, we wait for things to calm down. And in doing that, we guarantee underperformance. In a minute, I will give you 3 rules that protect your strategy from your own brain. And they are a lot simpler than anything Wall Street wants you to think about. So what actually works? The Fidelity study already told you, doing nothing. But here's the trick. You cannot just decide to do nothing. Because when the market drops 30%, every instinct you have will tell you to act. So instead of relying on willpower, you remove the decision entirely. Rule 1, automate the investment before you ever see the money. Payday comes, money moves, you never touch it. It sounds almost too simple, but what you are actually doing is taking your emotional brain completely out of the equation. No decision, no temptation, no behavior gap. Rule 2, your strategy should bore you. If you find yourself excited about your investment strategy, that is a warning sign. Excitement means complexity. Complexity means you will be watching it constantly. And constantly watching it means you will eventually do something stupid with it. Broad index funds, low fees, nothing to monitor, nothing to optimize. The whole point is that it requires zero attention, because attention is what kills returns. The best investment strategy is the one you can completely ignore. Rule 3. Decide how much pain you can handle before the pain arrives. Most people figure out their risk tolerance during a crash. That is the worst possible time. Your portfolio is down, the news is catastrophic, your gut is telling you this time is different. That version of you is not qualified to make this decision. So the calm version of you needs to do it instead. Sit down right now, not when markets are falling, and decide, if my portfolio dropped 40%, would I sell? If the answer is yes, you are taking on too much risk. Adjust it today, write it down, because when the crash comes, and it will come, that piece of paper is the only thing standing between you and a catastrophic mistake. Nobody teaches this part of investing. They teach you what to buy, they teach you how to diversify, but they never tell you that the real enemy is not a bad stock pick or a market crash. It is the person holding the phone when everything starts going red. The Nobel Prize winner could not beat his own brain. The Fidelity winners did not even try, and that is the whole point. The best investors are not the ones who know the most. They're the ones who panic the least. Hit subscribe so you do not miss what is next. And let me know in the comments if you have ever panic sold. You are not alone.